We hear about interest rates all the time, but what are they really, and why should we care? In simple terms, interest rates are like the price of money. They affect everything from our savings to our loans. Understanding interest rates is important for managing our money and making smart financial decisions. Whether you're saving for a down payment on a house or taking out a loan to buy a car, interest rates play a big role. When interest rates are low, it's cheaper to borrow money, which can be great for buying a house or car. But when interest rates are high, borrowing becomes more expensive, and it can eat into your budget. Imagine you borrow money from a friend. Your friend might charge you a small fee for lending you the money. That fee is like interest. Interest is the cost of borrowing money. When you deposit money in a savings account, the bank pays you interest for the privilege of using your money. Interest rates are usually expressed as a percentage. For example, if you take out a personal loan with a 5% interest rate, you'll have to pay back the original amount you borrowed, plus 5% of that amount in interest. The higher the interest rate, the more you'll pay back over time. Interest rates don't stay the same. They go up and down based on various factors in the economy. One of the biggest factors is inflation. Inflation is when prices of goods and services increase over time. When inflation is high, interest rates tend to rise as well. Another key factor is the Federal Reserve, which is like the central bank of the United States. The Federal Reserve sets a target for short-term interest rates, which influences interest rates on everything from credit cards to mortgages. They may raise interest rates to combat inflation or lower them to stimulate economic growth. Changes in interest rates have a direct impact on our personal finances. When interest rates rise, it becomes more expensive to borrow money, but it also means we earn more interest on our savings. On the other hand, when interest rates fall, borrowing becomes cheaper, but our savings might not grow as quickly. For example, if you have a mortgage with a variable interest rate, your monthly payments could increase when interest rates go up. However, if you have a high-yield savings account, you'll earn more interest on your deposits when rates are high.